Usually, the price reacts to order blocks and changes direction upon reaching them. However, order blocks sometimes fail, and the market reacts to other levels instead. Why does this happen? The reason is the presence of inducement and liquidity in the market. In this video, we will cover step by step what inducement and liquidity are, including their structural and candlestick definitions. We'll also explore the difference between valid and invalid inducements, explain the types of inducements in the market, and show how to effectively use them in our analysis. Let's begin by defining liquidity and inducement, as they are often confused but represent distinct concepts. Liquidity refers to areas on the price chart where a large number of orders are likely resting, such as stop losses or pending limit orders. Market makers and institutional traders often target these zones to trigger stop losses or to fill large positions efficiently. And inducement is a deliberate price move designed to tempt traders into taking positions too early or in the wrong direction. It often happens right before the market shifts strongly the other way, catching those traders off guard. This tactic is commonly used to create liquidity for bigger players to enter or exit the market more effectively. In simple terms, liquidity refers to the money present in the market. It appears in the form of stop losses, stop orders, or general buying and selling activity. Liquidity can manifest as equal highs and lows, swing highs and lows, or even as trends within the market. Inducement, on the other hand, refers to a form of market manipulation that allows large traders to take money from retail traders. The structural formation of an inducement in the market appears as a pullback. The market's price movement structure within a trend consists of impulsive and corrective waves, and this cycle is continuously repeated. Furthermore, the structure itself is composed of smaller movements. If we look at the market in terms of candlesticks, a bullish movement is considered impulsive as long as each newly formed candle breaks the high of the previous one. This continues until a new candle breaks the low of the previous candle, signaling the beginning of a corrective move. Even if a bearish candle forms, it is not considered corrective unless it successfully breaks the low of the previous candle. If the candlesticks fail to break below the low of the previous candle, they are considered inside bars, not a corrective. However, the market structure differs from the candlestick formation. This entire movement is considered structurally as just an impulse without any corrective phase occurring. In structural terms, we can only regard a movement as corrective when the price pulls back and sweeps the lows of the previous candlestick. For example, in the candlestick movements on the opposite chart, the market has moved through several phases, both impulsive and corrective. However, when we look at the market structurally, we can see that there has been only one corrective phase, which occurred when the price swept the last low of the impulsive move before forming another impulsive phase. The next step is to determine whether the pullback is a valid or invalid inducement. In a bullish market, after the price forms a major high, two possible scenarios may occur for the trend to continue. The market might make a corrective move and then resume its trend by breaking through the major high, or it might continue its trend without any corrective movement. In the first scenario, the price breaks below the low of the last bearish candle or sweeps the final corrective move of the candlestick pattern, thereby forming a corrective structure. It then continues upward by breaking the previous high. This movement is considered a valid inducement. However, in the second scenario, the market continues its trend by simply forming an inside bar, without sweeping or breaking the low of the last bearish candle. As a result, no inducement is formed, and it cannot be considered valid. There are two important points to keep in mind. First, the break and sweep of the last bearish structure in the candlestick pattern may occur through a wick or candle shadow rather than the body of the candlestick. In such cases, it is still considered a valid inducement. Second, the inside bar structure might form in a broader manner, closely resembling a valid inducement. However, it is important to remember that both conditions, the sweep and the break of structure, must be present for it to be considered a valid inducement. Take a close look at the chart on the right. The market made a strong impulsive move that created a break of structure, followed by a corrective pattern composed of several smaller moves. In your opinion, why was the first price break an invalid inducement that the market rejected, while a valid inducement was formed afterward? As we discussed earlier, for an inducement to be valid, the price must break or sweep the impulsive candlestick structure that formed a major high or low within a corrective move, which is exactly what has happened here. In contrast, the internal area formed during the corrective move did not create a major high and was merely part of the market's corrective trend. Therefore, it is not considered a valid inducement. There can be two types of inducement forms in the market: major and minor inducements. A minor inducement occurs when price retraces to a valid order block and breaks through it, but that order block does not play a significant role in shaping the overall market structure or triggering a structural shift. In contrast, a major inducement involves a retracement and break of an order block that served as a key structural level 1 that acted as the foundation for a major move and contributed to a market structure break. To better understand this concept, it's best to explain it structurally. Imagine that during a bullish movement, a break of structure occurs along with price movement, and several order blocks are formed throughout this trend. Now, when inducement happens in the market, we can only identify it as a major inducement if the price returns to the order block that initiated the move, which caused the break of structure. Otherwise, inducements to other order blocks are considered minor. Now, suppose the structure was slightly different and the second order block occurred after the break of structure. In that case, if an inducement occurs in the market, it would be considered a major inducement. Keep in mind that an inducement is only regarded as major if the market movement originating from that area leads to a break of structure. If you consider the candlestick pattern in the same way, and the next order block is formed after a break of structure, then after the inducement occurs, both of these areas can be considered major inducement. You might be wondering about the difference between a major and a minor inducement. In market structure, key trading areas such as highs and lows, entry zones, or market reversal points are considered more significant when they occur after a major inducement rather than a minor one. We'll explore this further in the next step. For example, in this chart, the price created two order blocks after a break of structure. As the price retraced, it broke below the first order block, and an inducement occurred. According to the earlier definition, order blocks that did not initiate the trend leading to the break of structure and were merely formed along the trend are considered minor inducements. After this inducement, the market resumed its bullish trend, resulting in another break of structure and a new higher high. The important point here is that, since this higher high occurred after a minor inducement rather than a major one, it does not represent a valid zone. In other words, if the market structure behaves in this way, forming a break of structure and an order block after a minor inducement, we cannot consider this area a valid trading zone. Following the market's reversal and the price breaking through the order block that initiated the trend, a major inducement has formed. As a result, the highs and order blocks formed after this inducement can be considered valid, and this area may serve as a potential trading zone. So, how can we enter a trade after a major inducement has formed, and what conditions need to be met? The first step is to analyze the market structure on a higher time frame. Here, we have the 4-hour chart of gold to US dollar. Based on previous information, we expect that during a bullish movement, the market will form an inducement before creating a new higher high. Once this inducement is formed and the price resumes its upward trend, we can start looking for entry confirmations to take a trade. As the market continues, we observe that the price breaks through the order blocks and creates several inducements. However, as we mentioned before, we can only expect the formation of a new high or low if the price has formed a major inducement. If only a minor inducement occurs, there is a possibility that the price will move back toward the previous order blocks. The next step is to enter the trade on the lower time frame, the 15-minute chart. On the lower time frame, two confirmations are required to enter a trade: a liquidity sweep and a market structure shift. Once these two conditions are met, we consider the last order block as the entry zone. The stop loss is placed slightly below this area, and the take profit is set at the major inducement that may form. We can also see the result of our trade on the higher time frame. However, keep in mind that no strategy works perfectly all the time, so be sure to backtest it before using it. Always manage your risk in trades and aim to maintain a favorable reward to risk ratio. I hope this video has been helpful so far. Don't forget to like and subscribe.